Hey guys, this is Boom Traders. Welcome to the weekly overview for week 19. Today is the 15th of May, 2022, Sunday. I'm TinTinTrading and I'm going to go over the general market with you and show you our risk appetite in this current market. As always, the general session overview, we're going to go through the two models, the risk-based model and the tactical trading environment. We're going to look at the current market, and at the end, we're going to finish with a summary. The video is going to be rather quick, so hopefully it will be informative and useful for you within your trading week. The risk-based model, we haven't had any change since November 22nd, and we're just getting everything in red negative territory, and we're getting this signal negative. If we look at the tactical trading environment, we're still on red. This means that the breakouts are not working well and maximum caution is advised. We have a few setups that are coming up, not much. The market is bouncing, but this doesn't really matter if we cannot see the setups to trade. So there's definitely this philosophy within our trading whereby we are led by the stocks rather than being led by the general indexes. If we look at the Nasdaq Composite, since this sell signal that we covered on 22nd of November, which was very precise on the high before the correction, we've had this massive move down. And as you can see, we got about 30% drawdown since the top. Now, this is considered a strong bear market, and general definitions that is used is that once you get down under 20% decline in the market, this is considered a bear market. So we're definitely in a strong bear market within the Nasdaq. When it comes to the S&P 500, as you see from this sell signal up here on the 22nd of November, we did have a small correction and made a marginal high, but from then on we topped out, and so far we're nearing that 20% territory. Now we look further on for a few models, and I'm going to show you two models that we've subscribed for. This one is from Fundstrat. There's a saying that if you torture numbers long enough, they'll tell you everything that you want to know. And this is definitely the situation at the moment. And I'll show you how we look at studies like this. So this study, the WaterFall study, looks at the time when the S&P 500 has corrected more than 16% in 5-month period. And what has happened since? This is indicated by these red dots. So these are the times when that has happened. This is the correction. And this on the top is the S&P 500. As you can see, the last few times, those 3 times, when we got to that minus 16% decline, it really indicated the bottom. But you can also see that in 2008, here for instance, this was only the beginning of the correction. So it's not a single answer or a single model that can be really trusted, but it is something to consider, right? So these kind of studies and other similar kind of studies, especially with sentiment and oversold conditions, it really depends when you look at the general and broader picture. So in this case, we'll be looking and trying to assess whether we're in a secular or a cyclical bear market. And this, of course, depends on the economic cycle. Now, for those of you who do not know, the secular bear market is referred to a large decline. As I said, it can be defined by 20% decline, but the secular bear market can last anywhere between 10 and 20 years and is characterized by below average returns on a sustained basis. Now, the cyclical bear market is the one that can last anywhere from a few weeks to a few months. So we really want to assess whether we're in a cyclical bear market, as those are the instances here, or whether we're seeing secular bear market as the instances here. And from then on, we can assess that models like these, whether they are showing a bottoming fashion or whether they're showing kind of the beginning of the decline, as we have seen both in these cases. Now, this page looks at the times between 2000 and 2022, but the model from Fundstrat runs all the way back to 1970. And you can see similar thing here. In the 1990s and 1989, this has indicated the bottoming, but in 1974 and 75, whereby we got a much bigger correction, we got more decline. So from here, as I said, it's important to assess the economic cycle because this will be the main tail, if we're getting a bottoming now or if we're moving upwards from here. Now remember, we did say last week that we're in the second year of the presidential cycle, and this is the worst year in the cycle. This is a seasonality point, but it's just another headwind. We're not buying or selling because of this, but we have to be aware of all these seasonalities that are stacking up and seeing where probabilities are more in our favor or not. Now, if we look and backtest the instances shown by the Fundstrat study, we see that in general, there is no real conclusiveness on just a single number. The first problem from a quant approach is that you would see that we don't have any statistical significance. Now, we've only have about 18 instances, and that's way too little in order to assess any kind of significance and correlation. We see that in 2001 when we had the dot-com bust and the general financial crisis in 2008. Both times, the 12-month forward-looking rates after the 16% decline were quite big. In the general financial crisis, it was about 43%. So this can be very big drawdown if we're getting into this secular bear market. So remember, when you look at studies like this, you want to know where you are in the market, and you want to put those studies in the perspective of the broader picture and how the market is acting around that time. And look for other elements to see if probabilities are stacking in your favor or not. So these are, I'm showing you the numbers, but as I said, we don't pay big importance here. So we're going to start now looking at different indicators for the economical cycles, the sentiments and seasonalities, which can give us a bit more tail whether or not we are in a secular or cyclical bear market. Now, the first thing I wanted to share with you is the AAII Sentiment Index. And we see that we've only had worse times in 1990 and 2009. Now, that's here and here. We have high reading on the sentiment and high bearishness on the sentiment, which is good if we're about to hit bottom in this cyclical correction, and we'll be hitting a low. Because from here, we can say that this is confirmation that things are likely to turn up. Now, this would not be the case if we're getting into a recession. And it's important to know if we're getting a recession or no, because this will be the telling sign about the secular bear market. Moving on, we're looking at the S&P 500 again, another model. This is from Ned Davis. And we're looking at the S&P 500 post-war recession starts dates. So as we said, we're somewhere here around the 0 point. And this is the place where we want to see if we're going to get some traction. So if we start getting some traction, we will likely move up from here. But if we are not, and if we get a recession, the market is going to continue moving down. And there's more to the downside to be expected. But we're definitely not there yet. Now, if we look at the times when we get out of recession, the market has generally discounted that already. So this is the recession end date, 0.0. And generally, the market discounts that about, on average, 4 months prior to that. And this is when the market is likely to start rallying 4 months before the recession, whereas some stocks are likely to move up, set up, and break out about 6 months prior to that. So it's really this question, are we getting in a recession or are we not? Now, we've looked at a bunch of economic cycle models, and we wanted to see if the elements of the recession are coming along or not. And we're not seeing anything like this. This, of course, doesn't mean that it can't happen, but it doesn't seem likely at the moment. There are various moving parts, of course, but as you can see, here is the advisor's perspective, weekly growth model. And generally, when we get under the zero territory down here into the lower 30s, it's indicative of recessions. And we're nowhere near that. We're quite safe. But as I said, there are different moving parts that we have to consider. The Ukraine conflict, dragging NATO into it, the tightening of the Fed rates, and the inflation numbers. But we've covered that in previous videos. I'm just bringing those into your attention when we assess this larger perspective. Of course, if we don't get a recession, we might get this 1998 cyclical bear market play, and we've covered that in previous videos. And I'm just going to bring it up again just to show you what it looks like. This is 2-leg down movement before a further move up. And if we move over the headwinds, this is likely to come up. And it will present itself as a fantastic buying opportunity. So we're hoping to get something like this, but at the same time, we're trading here and now. We're just assessing what is happening and where probability is. As I said, we are still in the second presidential year cycle, which is the worst year in the cycle. This is another headwind. But when we come out of that, actually the sky seems clear from this model, as we're likely to get a very good backwind in terms of the stock market moving up. So we're not buying or selling because of this, but we just want to be aware of it. It's another part of the puzzle. The other important thing is that we believe that the speed of the rate hikes is rather important. And this is a simplified picture of something that you've been seeing for the last few weeks. And as you can see, we have the fast tightening, the slow tightening cycles. And we believe that we're still on the fast tightening lane. Now, the CPI report did come out last week and that was okay. And the market took it well, a speed that the Fed is currently looking at. And the main reason for this is because of the inflation fears. Yet, when we look at what analysts think, and as many times analysts are completely wrong, but if this kind of prediction turns out to be true, they're expecting inflation to come down to the about 2% by within 1 year, which again would present itself as an amazing buying opportunities. We also had the 10-year Treasury yield. Now, the rates did come down a bit last week, as you can see up here, but again, are quite high. And we're looking at this level about 3.24. If we move above, is likely to make it very tough for the market, at least for the short term. Now, a few other things on our model, whereby we look at the action and we compare it against the volatility. We have moved from the bearish volatile sector to the super bearish volatile sector, which again can signify bottoming action. Generally for us, the easy dollar environment is when we get to here. We're nowhere near that. So we will be very cautious when we open position. And just to show you where this comes from, and we'll be doing a longer video on it, but this is the S&P 500 and we have both these indicators within their respective zones, which are back tested. And we are seeing that we're getting this low. We're trending down. This is the market action and this is the volatility. Now, as you can see here, this level down here, we've been getting it a few times. And apart from 2008 and 2002, every time we get to that level, it does signify some bottoming action from here on this price action. Now the volatility is spiking up, which is not exactly great. We would like this to actually move down. So we'll be looking for this to move down from here, which is more in line with what we want to see. So in a summary, we're getting red across the board. We are in a bear market and we are seeing distribution everywhere around us. We do not see many stocks that are setting up. We didn't get a follow through day last week. So if we're getting a bounce, it is a bounce from the oversold levels and nothing to write home about. The good thing is that this can change very fast. And that's why we are paying very good attention to the market, because stocks might set up very quickly and things might move around very fast. If we have made a low, and this is anyone's guess by now, but without the stocks, we have to be in cash for now, and hence why maximum caution is advised. Hopefully this was helpful. Join our Discord team if you like this type of analysis, and see you in the ring. Thanks, bye.